So let's talk about GameStop because actually in a previous session that we talked about, we mentioned our friend Elon Musk and Tesla, and we talked about the losses that the shorters have made on the business. And I think there was an article on CNBC, I think it was CNBC, where they said that those that shorted the Tesla stock last year lost a total of $40 billion on their short positions. But shorting has become a really hot topic in the last few days with GameStop, as you've got there on the screen, Ted. Let's talk about this. This is a really interesting topic, and I'm sure the financials are going to be really interesting to look at as well.
Absolutely, Moeed. So I think it's important before we start talking about shorting and what shorting is, let's actually just look at GameStop and see what's going on.
Yeah.
And you're absolutely right that recently GameStop has, there's the share price, over, since it was founded. And you can see it's been kind of tiddling around below $100 a share. Recently be getting even lower and lower. I think it was 2016, it was at $30 a share. The start of 2020, it was down to $6, and by midsummer, it had dropped to a low of $4 a share. So if you'd bought at $4 a share and it's now at $325 a share, you'd be sitting on quite a nice little profit there. So the question is, why? What is this company doing that everyone suddenly realized this is a great company, I've got to buy the shares? So I thought we should have a look at the financials first, Moeed. So here we go. And we're going to look at the income statement to begin with, where we show the profit and loss account. So here's the income statement. And you'll notice that if we look at 2019, which is our latest year, we can see sales of about 6.5 thousand million, so that's 6.5 billion, which is down from the previous 2 years. So it's actually shrinking. And you'll notice that they make a loss of about $470 million. So that's nearly $500 million.
Wow.
The main reason for that loss is that they're actually operating. So here they're operating at about a 30% gross margin. Okay, that means that these guys, they're buying and selling video games. They've got lots of high street stalls, for example, and the cost of selling those games, they're buying them for 70 cents, selling them for $1. That's effectively what we're saying here. The problem for these guys is this number here. And this is the cost of running the business, which includes all of their high street stores. And the stores are just too expensive. You think about the revolution going on in retail. Companies like this, they're operating in highly competitive markets. It's very, very low margin. They just can't afford the stores.
And what's interesting is that cost is actually down from the previous 2 years. However, the gross profit has dropped from the last 2 years. So it's worth noting that.
Well, you're absolutely right. The reason probably is actually in this line here, which is discontinued operations. So they're actually shrinking the business. They're selling unprofitable parts of the business. They're selling unprofitable stores. So that's why the sales have been declining down. And that is why this number has also been dropping, for example. So they're trying to get back to some sort of profitability. And actually, interestingly enough, there's a little bit of interest in the second half of 2020 as a chap called Ryan Cohen started to show interest in the company, as he reckoned that maybe there was a turnaround story. Maybe we ditch the physical stores, bring it online. And actually, that caused the share price to come back to about $20, for example. So there was a good news story actually coming into these numbers. Before we look at that, though, let's just look at the cash flow. The top line here is showing the profit. That's from the profit and loss account. This line here is showing the cash profit. And what we can see is that actually by 2019, not only were they making a loss, they were losing cash as well from their actual underlying trading activities. And this means that the company is starting to struggle on its cash flow. So there's the cash loss. It's investing a little bit, not a huge amount. You'll notice that there's a bit of a divesting. So this is them selling parts of the business, selling companies in previous years. They're kind of trying to get rid of the stuff that doesn't work. They had to make a repayment on some debt, and so then their cash flow overall went down by. So that's using the financing. So their cash has gone down by over $1 billion. So they started with 1.6 in the bank and they finished with about 500. So they're starting, they're slowly running out of cash is basically the story here. Can Cohen turn it around? Can Cohen come in? Can he turn it around? Can they rescue this business? Can they change the business model? Can they accelerate it out? Balance sheet not looking too bad. So we see the total assets here, about 2.8 billion, again significantly down from last year. The business is contracting. It's trying to get back to its core. The current assets are okay when compared to the current liabilities. There's a little bit of debt sitting around on the balance sheet. So there's the debt. And the equity. So this number is the equity. This is the shareholders' funds, and you can see that this number has fallen. And the reason it's fallen is here because it's making a loss. So effectively, it's historically it's been making profits, and now it's making a loss. It needs the turnaround. Okay, and so the question is, what have they done to cause the share price? I mean, this has got to be a really successful story. Any thoughts on those numbers, Moeed?
No, I mean, other than the obvious, which is this seems to be a business in decline. Most of its operations is in retail, so physical bricks and mortar stores. We all know the story of those businesses from the pandemic. No surprises there. So, like you say, based on the financials, for the share price to go up, we're hoping that there is some sort of finances behind that, right?
Well, these are the finances. So clearly the answer is not in the numbers.
I thought you were going to bring in some financial surprise that only you experts will know about.
No, the only thing what I would just mention is the working capital. They hold inventory for about an average of 85 days based on these numbers. They've got very, very low accounts receivable. You'd expect that's a cash business. Their accounts payable about 63 days. So they've got about negative. So they've got working capital requirement of about 30 days, which is not unreasonable for a business like this. So it kind of, it feels, it's okay. It's declining. It's not profitable. It's losing cash. The working capital is all right. The balance sheet is just shrinking. I mean, this business, it's kind of heading to disaster. So really, the question is what's going on?
Yeah, so you're saying, based upon this, that this share price increase is purely either speculative or the news we've been hearing about. It's not based on financials.
Absolutely. And actually, interesting enough, when you look at the market cap, so I've highlighted that in the bottom left-hand corner. So the market capitalization screen print of this was 22.6 billion. The balance sheet, you remember we looked at the balance sheet just now. So if we compare this number here, which is the net asset value, and we compare it to the value of the business, in effect, if you were to buy this business today, you're going to pay 22.6 billion for a company that has net assets of about 600 million. Yeah. Okay, so basically you've got 22 billion of goodwill in there. Which kind of, we're back in Tesla territory here. Yeah. There's no P ratio. This P ratio, there's no P ratio because there's no earnings. So you can't divide it by a negative figure. So the P ratio is effectively irrelevant. So let's look at just what's been going on actually here, Moeed, because it's quite an interesting story. So I've looked at this, and you can see the 6 months, it goes all the way up and then all the way back down again and then all the way back up again. So it's quite volatile. Just this last little bit up here, where you're talking about over the last few days. And if we look at what's going on, this is where a lot of people have been talking about a short rather than a long. Okay. And it's worth, you know, people often try and make these really, really complicated. It's very, very simple. Fundamentally, it's not as simple in reality, but the concept is very, very simple.
Right.
So we talked, for example, recently about Coca-Cola. Let's take an example, Coca-Cola. And we said, if you think Coca-Cola is a good investment based on the fundamentals, you should buy a share in Coca-Cola. And I forget what it's trading at, but let's say for sake of argument, it's $100. So very simple, you buy a share in Coca-Cola, hoping that the share price will go up, okay? And that's known as a long investment, and that's traditional investment, and that's kind of what most of us do. Coca-Cola is going to go up, so we buy a share in it. But what if you think Coca-Cola is going to go down in value? Well, at this point, what you might want to do is to short the share, okay? And the shorting the share involves selling it today and then buying it back tomorrow at a lower price.
Yeah.
Okay. Now, if you sell it and you don't actually have the share to sell, that's known as a naked short, Moeed, and that's illegal, and you'll go to jail for that. Okay. So what you do is you phone up your friend. So let's say we've got a friend here who's got a share in Microsoft. He's a fund manager. I phone him up and I say, can I borrow your share from you? And he's going to charge me a small interest rate. Okay, so I borrow his share. I've now got the share certificate. I sell it today. Tomorrow, and I sell it for $100. Tomorrow, I go back into the market and I do what's called closing out my position. And closing out my position, very simply, is buying the share back again and giving it back to my friend who's the fund manager. Now, he's happy because he's made that little bit of interest on lending me the share. I'm happy because I sold it for $100 and I bought it back at $50. I've made a profit of $50.
Yeah.
Sounds nice and simple. Now, there's a risk here because I'm betting it's going to go down in value. But what if it goes up in value? Well, then I have to go into the market and pay $150 in order to buy the share and give it back to my friend, because I've got to do that at some point. I've got to give it back.
Yeah.
Okay, so I've got to close out my position. And what you see here, Moeed, is that if you are a long investor and you buy a share in a company for $100, the most you could lose is $100.
Yeah. Yeah.
Okay, but the upside is unlimited. Okay, and this is a very important concept. If you short a share, the most you could gain is the value you pay for that share, $100. So if I buy the share for $100 and the company goes bust, I get to keep my $100. But potentially the most I could lose is infinite.
Yes.
Because if it goes 100, 200, 300, 400, $1 million, $1 trillion a share, you know, that's what I'm going to lose.
Yeah, and that's what happened to those Tesla shorts, right? They're
absolutely. Okay, so the key here is that when somebody shorts a stock, they're not just taking a punt. Okay, you do your homework. You really make sure that you understand what's going on here. Now, so long and short, we're happy, Moeed, long and short.
That sounds very clear to me.
Okay, so let's talk about a short squeeze. Okay, so what we've done is we've given the example where we take the share and we sell it into the market. Okay, now a good example of this is VW back in 2009. Okay, when people were shorting VW, the people who were buying it was Porsche. Porsche were effectively buying their own shares. And so when the shorters had to close out their positions, and don't forget, if you're shorting a share, lots of people are selling the share price often comes down. It actually becomes a self-fulfilling prophecy. Just as if everybody's piling into a stock, the stock price goes up. So if everybody's selling the shares and the share price is going down, at some point they have to close out their positions. But if you go into the market and the people who own the shares go, I'm not going to sell you my share, we have a problem. So you have lots of people who need to buy the shares back and give them back to their friend, and lots of people sitting on the other side of the trade going, no, I'm not going to sell you my share. So if there's only a few shares in the market And lots of people who are now the short sellers who need to close out their positions and they need to buy those shares, what happens to the share price?
It goes up for sure.
Absolutely. And this causes this short squeeze. Okay.
Mm.
And so what you end up here is that the shorters, the shorting hedge funds, people like Melvin Capital, Citron Capital, were suddenly trying to close out their positions. They couldn't. The people sitting on the other side are these the investors who are chatting on the Reddit, who are all saying, hold on to your shares, don't sell them, hold on, you know, watch the share price go up, etc., etc., etc. We're going to stick it to the man. We don't like these hedge funds. We're going to kill them.
Yeah.
Okay. And of course, you know, Melvin and Citra, they've got to close out their positions. They're watching the share price goes up. As it goes up, their losses are getting bigger and bigger and bigger. They're under more pressure to sell them. They can't get the shares, etc., etc., etc. And you know, you can see that they've been booking massive losses. They've had to go into recapitalization because of this.
Mm.
Now, the question here is, I like this stick it to the man. Are hedge funds the enemy? Now, there's a little bit of a hangover here from the financial crisis, Moeed.
Mm-hmm.
And I understand the kind of, the investment bankers and the kind of, this kind of, this greed is good in Wall Street. And, we still haven't really got over the financial crisis of 2007 and 2008, when effectively the banks went bust and then the banks were bailed out and the rich get richer and the poor get poorer. And I get it. And there's a lot of hedge funds out there who they run on what's called 2 and 20. They charge 2% fee and then 20% for any profits they make, and it's exclusive and Mayfair offices and lots of money and only the wealthy can invest. And they create and they have created that image for themselves. But hedge funds are kind of the mavericks of the investment world. Most people in the investment world are long. They buy something because it's going to go up, and it doesn't go up, but they just sit on it until it does go up. So the hedge funds, especially the short sellers, these are the guys who are going in and going, no, this is not going to happen. We're actually going to short it. We're going to take a punt. We're going to bet everything that we think that this is going to go down in value. They don't always get it right, okay, but they kind of, they are sitting outside of the investment community. These are not your kind of standard bankers. These are the mavericks of the investment management community. They're the kind of the hated people in that community, because often if you're long a share and the hedge funds come in and they start shorting it, that can kill your career.
Yeah.
Okay.
I mean, the other perspective is, I'm part, and this is interesting what you're saying, I'm part of an investment community, and they feel that shorters are a necessary balance to the stock market, because when done right, and this is very important, when done correctly, and for not, I'm not going to say ethical means, but when done correctly, because they basically what they do is they call out businesses to account, right? They are saying, hey, you are not worth the money you are. You're a danger to some of these long-term investors. You're a danger to some other retail investors who may not be as savvy. Therefore, we're going to short you because actually you're charging a higher price for your stock when actually the fundamentals or whatever reasons are not there. So it's interesting that you say that, because I'm part of an investment community that feels the same.
And you're absolutely right, Moeed. And a good example of that is Wirecard.
Yes.
So Wirecard, if and the German regulators, they couldn't find it. I mean, it was crazy. I mean, they actually had the German regulators' employees were trading in shares in Wirecard. Yeah. Who called it out? The hedge funds. Okay, yeah. The shorters, the hedge funds who were shorting Wirecard. They said, no, there's fraud going on here. This doesn't add up. It doesn't make sense. They did their homework, and they have to do their homework, because if they get it wrong, they go out of business. So they only make a call if they're really, really, really confident that it's the right call.
Yeah, and interestingly,
so
one of the biggest shorters for Wirecard was Jim Chanos, who also lost a lot of money on the Tesla short. So that was interesting.
Absolutely. So they, as I said, they don't always get it right. And you know, there's a great quote, we've used it before, we'll use it again. John Maynard Keynes: markets can remain irrational longer than you and I can remain solvent. Okay, and it's worth remembering that. And that's what these short hedge funds will live and die by. So it's really important we realize this is what's called destructive capitalism. So, you know, destructive capitalism is you kill the industries that cannot survive, and that allows the industries that are really good business models to thrive. What we live in today is something we often hear about: zombie companies kept alive by low interest rates. They're just lumbering along. So if you take GameStop, for example, if GameStop dies, what it means is that the people who are buying from GameStop will go and buy from a much better company that can provide them with a better product and a better service at a lower price. Okay, you know, that's what capitalism is. It's Darwinism. It's not nice for the employees of GameStop, but you know, that's the way we survive. You know, it's Darwinism at its basic.
Yeah.
Now, I just want to talk about who picks up the tab for this. So, you know, we're looking at this this short, and here is the short there. So somebody owns these shares. There are people out there. These are the investors who are talking to each other on Reddit, and they've said, yeah, let's stick it to the man. Great. So they bought some shares, and some of them will have bought shares at $300, $325, $200, $250. They're now sitting on a share in a company that's making a loss, that's running out of cash, and is potentially very likely going to go bust, or is just going to limp along and trying to change the business model. Who loses?
Well, it's going to be the people that hold the stock, right? Because,
Absolutely. So who wins?
Probably the hedge funds who are supposed to be the enemy.
Well, some of the hedge funds are doubling down on their bets, and they're saying, no, we still believe this is going to go south, so we'll carry on. So you've got two parties here. You've got the hedge funds, and it's kind of who blinks first. But I can tell you this: if I'm sitting in the Reddit account, if I'm sitting, and I'm going, I've got some stock, I've paid $250 for it. At some point, you want to be out. You want to be out of that trade. And it's a little bit like being, the best metaphor I can give is like being in an enormous hallway, an enormous football stadium, okay? And there's only one exit.
Yeah.
And you know that the roof of that stadium is going to collapse. Where do you want to be in that stadium?
Yeah, I mean, closest to the exit. But hang on a second.
As close to the exit as possible. So you kind of, if you're not close to the exit, you want to be you want to be getting out of the exit. It is better to get out before it collapses rather than afterwards. So unless all of the Reddit are thinking, I'm going to invest $200 that I can afford to lose just to stick it to the man, which is fine. You're going to cut your nose off to despite your face. Absolutely fine. But I would suggest that if you're sitting on a profit, bank it early. So the people who win are the people who get in early and then fuel this kind of stick it to the man ante. They watch the stock go up and then they just come out very, very quietly and leave everybody else. There's a great book called Not a Penny More, Not a Penny Less. And it's a classic example. And this was written back in the 1980s, I think, by Jeffrey Archer. It's a classic example of people buy a stock today. They then create a story. The stock goes up in price. They quietly take their money out. And then when the story collapses, the people who bought in at the end are left holding worthless shares.
So just to clarify, Robinhood and some of these other brokerage firms, I know they've limited trade. Have they limited trade for buying more GameStop shares, or have they limited both the buying and selling of the GameStop shares? I think it's just the buying, right?
I would expect it's just the buying. But again, then you're back into capitalism. Why should they limit that? And actually, that's starting to manipulate the market. Yeah. So if you say you can't buy shares but you can sell, yeah, then you're actually you cause a crash. So you know, to a large extent, they shouldn't be allowed to do that. You know,
Yeah.
especially if the institutional investors can still trade and the
Yeah.
people who have a Robinhood account can't.
Yeah, and technically, if an investor did that, not a brokerage firm. So let me make this clear: if an investor did that, that's considered market manipulation, which is illegal, and there are plenty of examples of that.
Absolutely. So what you end up with here is you know, we must never underestimate the limit to human ingenuity in finding new ways to lose money. Okay, and GameStop to me is a great way to lose money, to get involved in Reddit and to listen to the kind of the chat that's going on. It's all noise. For me, it's about fundamental analysis. And you may be wrong in the short term. I'm not saying you can't make money by listening to the chat on Reddit and buying a share early. Moeed, you can make money buying a lottery ticket, but it's kind of high risk and it's not really good investment advice. Okay, so I would suggest if you want to play in those kind of arenas, absolutely fine. But if you're looking for something a bit more fundamental, I would ignore all the chatter and I would, you know, I would stick to your fundamental analysis of, you know, looking at, you know, finding good businesses which are undervalued and good businesses which have momentum, which have the fundamentals behind them. Yeah, so I'm not convinced. Sorry, say that again.
That's sound advice, right? That's a value investor.
That's not my advice, Moeed, because I'm not qualified to give advice. That is my opinion.
Sound opinion.
That is my opinion.
Yeah, and you described the fundamentals of a value investor, right? So
absolutely. Now, yeah, that's a completely different topic about value investing and momentum investing and value investing traditionally. You know, it hasn't done very well over the last 10 years, but and that's a separate conversation altogether. I'm just saying that if you're going to go and play in, you know, and there's a large argument that says lots of people have just been credited checks by the US government, for example. You know, if you get $1,500 and you don't really need it, you think, well, hey, let's try. Let's put money into, let's put it into Bitcoin. Let's put it into Tesla. Let's put it into GameStop. Let's get on these chat rooms and see if we can turn it into, you know, $2,000 or $3,000 or $4,000. And if I lose it, it doesn't matter because it was free money. Okay, so people maybe are acting in a slightly irresponsible way with this free money. Okay, and that's absolutely fine, but just be aware, go in both eyes wide open if you're on these trading accounts.
Yeah, that's great. And with this video, people now have the fundamentals, right? People now have some information around that, which is, in my view, in my opinion, a great balance to all the noise and chatter that's out there, you know, on the internet right now and social media. So thank you for that, Ted. That was very, very interesting indeed to see, and certainly a hot topic. So hopefully people will watch this and have a chance to look at those fundamentals.